Hello and how are you from wherever you guys are following me in the world? So I'm just going to try and explain. Somebody asked me a question about why I always use the words double bottom, and at times I also use the word double tops. So what I'll do is I'm just going to try and explain what do you mean by double tops and double bottoms, and I'm going to just try and use what I have in front of me. This is my trading template. I'll quickly try to explain what that means. Basically, when you I use what I say double tops or double bottoms, which is just basically a smart money strategy, and what that basically means. So I'm just going to try and expand this so that I can write some notes here. That when you're speaking about smart strategy, which just basically means smart money strategy speaks about what you look at when you come to these charts. And immediately when you're using smart money strategy, when you come to these charts, these are the things that you have to always look at. First of all, you have to look at the trend structure as your number one item, and then your number two item, you have to look at where is the money. Where is the money? Uh, Number three item, you have to look at uh, market gap or imbalance. Number four item, if you want, you can then try to use the Fibonacci. You can try to use the Fibonacci, and uh, number five, you can decide you're going to look at the session timing. But the last two are not all that important. Basically, for me, what I always look at critically is I look at the trend structure. Where is the money? And when I speak about where is the money, then this it means I'm looking at the liquidity. When I speak about liquidity, that's what it means by double tops and double bottoms. So, to me, basically, this is what I look at, and I'm going to leave them here as we are going to try and dissect our trade. So, I'll just do a quick glance and leave ignore these other notes. These are the notes that I had written about the DA. Let me just delete them. I just say that. The market on its way up as a result of inversion. So this was a market gap that was filled. So I'll just quickly delete that and leave it as clean as we can have a look at it. So if you come to the market, so right now I'm looking at the dollar or the Dow, or others call it the Jones. But it can apply to any pair or any particular market on trading view. So if you come to here, you look at the number one issue. You have to look at what is the trend structure. So if you're looking at the trend structure, most of the time I speak about having a quick technical analysis on what we call the top-down analysis. For you to get the trend structure, then it basically means that you have to be looking at the market either from a 4 hour time frame or the daily and above. So for example, if you are to look at this market on a daily time frame, basically what this shows us that this market is on an upward trend, because this is what it shows, that you're looking at it from an upward trend. That's what it shows, that from this date, which was on the 26th of May 2021, up to today, the market has been going up and up. But what that basically means, because you've drawn this trend line, is price has respected this trend line, which just translates to price comes up to the trend line, then it goes back, comes back almost up the trend line, goes back, comes back, um, crosses the trend line, and in most of the time this will we'll call it a false breakout, because there are some people who will think that price has crossed the trend line and this is going in for a sell, but they'll be in for a rude shock because immediately price will revert and will go up. And the same thing that has happened here, that we've had false breakouts. So basically, if you do a top-down analysis, you look at it from the daily or even the weekly, it's still the same thing. Price is on, or it's on an upward trend. This higher time trend just help us to gauge the direction of the market. If you break it down to the 4-hour time frame, it's basically just the same thing. It shows you how price has been moving. So that is what I'll call the trend structure. At times, you can also look at trend structure in a different way, a different perspective. So, for example, like if you look at this market, this the trend structure. If I was to use this as an example, it shows that the trend structure basically means that price has been ranging. So, if you're looking at it from this perspective, this is the trend structure. So anyone who will have to trade this, because this is a higher time frame. For a higher time frame, you can trade within the trend structure. What that means is you can get into a buy at this level and get into a sell at that level. Because if you try to look at how many pips will move from here to there, that is basically around 103 pips, which is so much pips, you know. So that's what it means. And if you're looking at it from a slower time frame, then you look at it as consolidation, because you rather trade a range than and this is what we mean by a range. This is a range. Price is moving from here to let me click it again. Price is moving from here to here. This is a range, and then you can draw it as much as you can. So that is a range. So we've spoken about the structure, and then if you have to look at where is the money now, this is very crucial. If you're using the smart money strategy, then what you always look at, if you're looking at where's the money, and most of the time you've had me mention about market gaps. And this is how the big boys trade. This is how the banks trades, is because they look at, they leave when they're making these huge moves. There are some gaps that they leave behind. So let me just try to use, I'll try to use this as a move, because basically we can replay the market. So when we replay the market, what that basically means is, we can hold on, you can replay the market from here. No, wait, can you replay the market? Yes, you can. Let me try to click there and click replay. Yes. So yeah, so there you go. So if you try to replay the market, this is from the 1st of March. We'll try to see how. No, I think we didn't get that clearly. Let's see if we can replay the market from here. Click replay, and that, and come on. Let me drop down a little bit to a 4-hour time frame and see if you can replay the market from there. Yeah, good. On a 4-hour time frame, it has accepted. So we want to replay the market from a 4-hour time frame from the 24th of February. Today is the 1st of March. So let's replay the market and see what happened. So if you play that, you see the market went up, came down, continue going up, came down, went up, came down. So today this is 25th. So the market will keep playing, you know, because what we're trying to look at is we're trying to look at liquidity. You're trying to look at from the 24th of February, where was the liquidity in the market. So one thing you have realized is the market, when it's making this huge move. So I'll try to use this one here, or let me use this move here. So when the market is making these huge moves, it leaves some spaces behind. So you see, like this space here, from here to here, this is what I call the market gaps. So every time you come on the charts, these are the first things that you're supposed to look at. If we move back a few days later, like 31st of January 2022, this was another market gap that the market left, that later it came to fill. This is a market gap. So from here to here, that is a market gap that the market left. If you can move it down further, this is another market gap that the market left. But then every time we have these little gaps, what it basically means is at a specific time, at a given time, this market gap will come to be filled. So if we start with this one, we come to say that this move was made on the 31st of January, but it was respected on the 24th of February. The market moved all the way down, but it came back up and corrected this move. If you look at another move that was made on the 3rd of February 2022, the market left an imbalance around this level. It still came back on the 10th of February. This move was corrected. And today, as I was playing, this is 1st of March. If I play further, let's see how price moved. So if I play further, we had this on this was the market gap that this move has been corrected today. So these are the some of the things that you have to look at every time you come to the market. Where is the money? This is where the money is. These levels that the market leaves, the market gaps, that is where the money is. Another place that I have to teach you guys where the money is every time you see these double bottoms, that double tops. So here it's a double top. This is where the money is. By what I mean by where the money is, anytime you see double tops or I'll try to use the one that has been used before. We have here double bottoms. Every time you see double tops and double bottoms, that is where the money is. Double tops and double bottoms. So here there is. This is where the money is. In most of the time, if you look at my charts, I'll try to use the dollar signs to be able to tell this is where the money is. So what basically means, so for example, for this move here, this is a demand area. So what it means is the people who entered this trade from here, going upwards for a buy. So when they did that, they put their stop losses here, left their stop losses just way below price. So as this trade moved all the way to here, these stop losses are still here and these guys are still in the trade, because from here what happened is the market decided to range. These guys are still here and they are hoping that the market will range, and because at times when the market is ranging, we as traders are not sure whether it will be on the upside side or it will go on a downward side when it decides to move. So when this market decided to move, it went on the downside, and all these stop losses that were here, which is where the money was cleared by this move. So what that basically means is whenever you see there's a double bottom or double top, this is where people have left their stop orders, and that's where the market will always drive itself to, because you see your broker is capable to see where most people have put their stop losses. So most people will put their stop losses where they will enter the trade for either a buy or a sell. So like here, why it's a money where the money is most people will put their stop losses here to enter into a sell. And what did these big boys do? They decided once they cleared all this money here, where the money was, they decided to move the price back and cleared all these stop losses where the money was on the upper side. And this is what it happens in trading. Like it's just a repetition of the same thing. The way the market moves is it will, when the market moves up or down, it will leave these market gaps. This is where the money is, or they will come for these double tops or double bottoms, and that's what happens every day. Every day you wake up and look at the market. That's exactly what the market makers are looking at. They're looking at what gaps did they leave. If they left any gaps, what are the other areas that where have people put their stop losses? Where have people put their buy and stop orders? And immediately they realize that that is where they will come, and that's where the market is. That's where the money is. And if you're looking at the market, it means you're just basically looking at price action. What has price done before? You know, what has price done before where the price is at the moment? And as we always say, that price will always be respected. Like, for example, I've used these two examples where price was at here at a certain level and it was here at a certain level. But from here, price moved. As much as it took, I don't know how many days for it to come back, it still came back. So price will always be respected no matter how many times it takes. And I've already explained that because that's what explains my market imbalances and market gaps. I've already shown you market gaps happen when price moves and this candle closes here and the next candle does not close here, because if the market is moving on a normal size, this is how the market is supposed to move. That the previous candle and the candle after, they close on one line. You see, like here, this is how it's supposed to be. So if at all this candle ends here and this one ends here and it does not end here, because this candle was supposed to end here. If it ended here, then there will not be any market imbalance. But because the previous candle had ended here and this one started from here, this has to be filled. But the thing is, if you move this price to a lower time frame, you'll find maybe it was filled on a lower time frame and not on a higher time frame. So if you come back to the you see, if you come back to the 1 hour time frame, you realize that this place has been filled. So if you go back to the daily, you see the daily shows there's a market imbalance, but if you come back to a 1 hour time frame, it shows it has been filled. So the secret is you go back to the lowest time frame, and if it has not been filled, then you know that there is already a market gap or a market imbalance. I think that explains it. The other sessions, we can learn them later. And thank you so much for tuning in. Practice risk management. You can like my video, either press the thumb button or the down button, at least to show YouTube that there's some engagement on the channel. Thank you.